Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address rshaw@fxcm.com, and of course today, Wednesday, it's the 8th of June 2022. I am going to conclude this in about 15 minutes, and then we're going to hop onto the crypto minute, and we'll just carry on. I just want to have the webinar separate for our website, which I'll upload to, and I'll put onto our Telegram channel. I'm just going to bring up a high risk investment warning. I'll keep this on screen for a few moments. Good morning, Howard. Nice to have you on the webinar as always. Thank you very much for joining. Hey, Anna, morning to you. Nice to have you on the webinar as well. Nice to have everybody on the webinar. Thank you very much for joining. And what I'd like to do here is just bring up now our market commentaries disclaimer. And just finally our references. So we'll start off with the CNBC morning note. I just want to talk to you about inventories. I just read an article this morning, targets inventories are moving up. And if we've got time, we'll take a look at a chart or two on MarketScope, and then we'll go through to the crypto minute and continue effectively the conversation. Hey, Rob. Okay, excellent. All right, that's it. Interesting. Rob's just saying I sent him an email and it went to his spam. So if you guys are waiting for emails from me and you haven't received them, just check your spam folders. I usually reply. I mean, I'd give myself a 90% rating. I might be generous there, but I have heard from a few guys that you know, they thought I hadn't replied, and then it's in the spam folder. So I'm begging your pardon, but usually if you don't hear from me, have a look there, and if it's not in your spam folder, then obviously just get back to me, and it slipped through the cracks. And it's saying thank you very much for the links yesterday, so thank you for that, Rob. All right, let's go through to the CNBC morning article. Hey, Zanetta, morning to you. Nice to have you on the webinar. All right, so it reads. So it's quite. I found the headline quite humorous because it's the exact same headline as yesterday, but slightly different. European markets head for higher open as investors gear up for US inflation data. Yesterday, European markets head for lower open as investors gear up for US inflation data. So it's the same headline with one or two words changed. All right, let's go through the news here. European stocks are expected to open higher on Wednesday as investors prepare for the latest reading of US inflation on Friday. That's important. It's the next piece in the puzzle. Last Friday we had the jobs numbers. The jobs market's still robust. We're still going to have tightening. What we want to see here is if the inflation has plateaued, and even if it's starting to come down, right? International markets have pulled back this week amid nervousness over forthcoming US data releases this week, including the latest inflation reading on Friday. May's consumer price index in the US is expected to be just slightly cooler than April, and some economists are expecting it can confirm that inflation has peaked. The University of Michigan Consumer Sentiment Index, also due on Friday, will be closely watched. So we did do a really good analysis of the consumer again 2 weeks ago, a week ago. So this is certainly something that I think we need to keep an eye on. Shares in Asia Pacific rose in Wednesday morning trade as investors look ahead to the Reserve Bank of India's latest interest rate decision, expected later today. Meanwhile, US stock futures fell marginally in overnight trading after 2 consecutive days of gains on Wall Street. Earnings come from retailer Inditex in Europe, and that is the whole article, so a little bit shorter today. Okay, I did read that target the big gigantic retail store. They've come out effectively with another important, I think, announcement, and they are saying that their inventories are building up. That's what Target said, and I think that it would probably be seen in most of the big retailers. Again, when we did that consumer analysis, we looked at something called the Red Book Index, which looks at these huge national retailers, which are marketing powerhouses. So it's a good way to look at retail sales besides the actual official retail number, and we saw that it was coming down quite severely. I think we've got to update that analysis because I think it's a key part of the puzzle. So I'll do that at some stage. But what I want to just do here is there is now I haven't done this, but if I get around to it, I will. There's a key metric that economists look at. It's called it's a ratio. It's your inventory to sales ratio. Every company is going to have it, right? Assuming obviously if they have an inventory, some companies their business models don't need an inventory, but certainly, you know, most companies would have inventory on their under their current assets. And what you can do is you can look at inventory to sales. And what's interesting about inventory to sales is just how it ties in with the business cycle. So the whole question that we trying to find out is, of course, is there a are we going into recession? Is that stagflation a real risk? And I think the inventory to sales ratio is another metric that perhaps can help us sort the wheat from the chaff, the chaff from the wheat. I can't quite remember, but the idea. Let's just take a look at the sort of kind of like a business cycle would be something like this, wouldn't it? And we would have over here. There's two cycles that you can see here. In fact, I'd like to do it a slightly different way. I'd like to do it this way. Let's do it this way. Let's do it down first. Let's do it up second. Okay, so what we have here then would be, this is what we would call a recovery. Okay, so this would be the recovery stage. We're kind of bottoming. Recovery, there we go. Recovery. Once you get through the recovery stage, the next part of your business cycle is typically called expansion in economics. What comes after expansion is peak. So we kind of peak in the cycle, and then what tends to happen once we peak is we move into your contractionary stage, and these are your 4 stages of the cycle. And there's different ways we can look at it. We can look at it generally in terms of labor, and we can look at it in terms of what else? Let me think about this very carefully. Labor and generally 3. There would be investment. Okay, so labor, investment. The way that what I want to introduce instead of labor and investment, just to give you. Sorry, I know we're pressed for time here. In economics, there is obviously you're looking. Economics is a strange social science because you're trying to look at the economy, which is it's a beast. I mean, to try and look at all the variables of an economy is just about impossible. So there's very different models, but they all simplified. So one of them would be something called, let me think, something called Cobb-Douglas, which is just saying your GDP is basically a function of capital and labor. And capital would be kind of your, in this case, it's just physical labor. And then what Cobb-Douglas does is it says, and for all the other things that we sort of can't measure, we're going to put it into technology, or it's called totals fact. So we'll look at capital, we'll look at labor, and then anything else we'll just lump into total. So I mean, they're very, very simple models of a beast. But one of the things that you can look at is inventory sales. Just think about it. What's going to be happening? What's going to be happening to your inventory just at recovery? Let's just think about this very carefully, just at recovery. So if you are a retailer, you're kind of moving in this direction, aren't you? It's you're experiencing this contraction. Well, you're probably not going to be ordering all that much inventory. Why would you? Business is bad, right? So you're cutting back on your inventory. What tends to happen at the recovery is all of a sudden, there is a kick up in sales because the economic conditions have changed. It just hasn't kind of registered because we're only right at the bottom. So at this stage, now look at this very carefully. Numerator stays the same because so numerator stays the same, but your sales kick up. Your sales kick up. So the bottom part of the ratio kicks up. Inventory to sales kicks up because you're at the recovery. So you haven't adjusted inventory, but sales starts. So what's going to happen to the ratio is that it actually, at the recovery stage, it kind of dips, which is weird. So a dip in the inventory to sales ratio is probably something almost counterintuitively. You're thinking, well, why is that happening? Is sales picking up? Why are sales picking up? Have we bottomed? Are we starting to see an expansion? And then all of a sudden the retailer reckons, wait a second, we've bottomed. It's time to start bringing in some more stock. So they'll start bringing in a lot more inventory. So as the expansion happens, your inventory to sales ratios typically increase. So it's a bit odd. You have kind of a dip in it, then you have a expansion in it, then it normalizes. Now think about this from Target's point of view, because this is really the crux of this discussion, right? The crux is, well, you don't really know when the recovery stage is. You don't really know where the peak is. So you carry on bringing in inventory. You carry on bringing inventory, but your economy, the economy peaks, so sales drops. So now think about what happens is that you've got this weird kind of, your inventory levels are constant. You picked up the pace of inventory into your expansion, and you just go along at that pace. But what happens is that your sales kind of dip. So your inventory picks up relative to your sales. In other words, you've got an excess inventory. That seems to be what Target is suggesting. They're saying that there is an excess in our inventory. So what does a retailer do to clear their inventory? They're going to have to cut their prices. Okay, so that's actually a good thing in terms of our. That's probably a good thing in terms of our inflation, because they need to clear the stock. So we're just going to have to watch out. But what it doesn't bode well for is in terms of the 4 stages: recovery, expansion, peak, because it's, to me, suggesting, wait a second, it's just another sort of cross, another negative that we're going to have to now keep our eye on. Is that, Well, you know, we've actually had, I think, some good numbers on the retail side, but not so much from the large retailers. And targets here, I think this is a big warning. I would suggest a pickup in targets inventory, considering just what type of a a company it is probably something that is worth keeping an eye on. I'm going to conclude at this point. I know we haven't covered too much besides the cycle here. We'll carry on in the next webinar, which we'll do right now, Crypto Minute. So please join me for the Crypto Minute. Okay, Rob, I see that. Let me come back to your comment in the next webinar. I'm just going to copy and paste it because I'll lose it. All right. Catch up with you in a moment, guys.